Thank you everyone for joining in today. We're here to talk about the NRI investment opportunity. And we've been doing a series of webinars on this particular topic, catered to each specific region, because what we feel like is that the dialogue generally at the industry level for NRIs is that it tends to bucket all NRIs into the same category because they're non-resident Indians, whereas actually each geography comes with its own nuances, and maybe having a more um, structured and relevant conversation could be helpful uh, for an NRI investor to explore certain ideas like how they should be looking at their investments now that they have global exposure, what their India allocations should look like, and of course, what we can do as a portfolio management service provider to fit into your framework of investments. So, with that, we'd like to begin. And I think to start off with, we have been saying this consistently through the year. We feel that 2023 is going to be a year that belongs to savers. And this time, it's all about what you do for your portfolio, right? It's not about what has my portfolio done for me. And I think that's going to be a really powerful decision that you make as an investor today. So, how are we looking at the market this year? We feel that equity markets are going to be volatile. And for some investors, that can feel like not a great place to be in. But in our opinion, that is actually the opportunity, because every time you see market downswings, we're able to buy the same companies that we like at a much better valuation. We also feel like this is a year where it's better to be more patient and cautious with your investment allocations, where an approach that involves waiting and watching and both staggering your entry and exit, right? Doing things gradually is what is going to get us to the best result. This is more of a hare and a tortoise here, right? We don't want to run to the finish line and get exhausted halfway through. We would much rather take it easy and pace ourselves, but do it consistently. And when it comes to portfolio construction, I think the key thing is that we need to differentiate between the seasons in which we are sowing seeds of wealth and the seasons in which we're going to be reaping those benefits. So clearly, 2023 is going to be a season to sow and not a season to reap. So the way we should be looking at our portfolios is not in terms of what is the return that I've got or what can I expect by the end of the year, because this is a sowing season. Things are going to take time, and you have to keep doing the work even if you don't see the results immediately. And another key thing that investors need to know is that valuations and risk actually move in the same direction. And market cycle after market cycle, this is a lesson that investors are learning as if it's a new thing, right? So when the valuations are cheap, your returns are going to be not great. Your risk is going to be fairly low, and this is the time to make an investment decision and move forward with it. But as valuations become better, your returns improve, your risk also increases in that particular idea. And this is where more investors start to feel confident about making a decision. But there is some procrastination that could create issues. So when the valuations are at their peak, the risk is actually at the maximum, but your performance is fully factored in. And it seems like this can go on forever. So we need to be careful, and we need to understand that when valuations are cheap, our investment actions have more weight on positive outcomes. When valuations are expensive, staying invested or starting new investments is what is going to hurt your overall performance. So again, if you want outperformance, you've just got to scale up when the chips are down. And I think you'll get lots of opportunities to do that this year. And another interesting thing about 2023 is that you're going to be spoiled for choice this year. It's not just about equity having great opportunities. I think you'll see investment opportunities on the fixed income side as well. And we have been able to do investments in gold in the past. So we'll have to see what other options the market actually places before us. So now coming to NRIs based out of Europe, what are the popular choices that we've seen? I think these are amongst the top. So NRE and FCNR deposits, I think, are the number one. NRE deposits primarily because they're tax-free. FCNR also because you're getting to save in your own currency of euros, and that's where you're seeing your returns. Your insurance plans are the next things, whether you're here or in Europe, we feel that this is a product that often gets pitched to an NRI audience. And we'll talk about whether these products work or what are the some of the drawbacks that could be there. Then you have real estate, which has been a popular option in the past few years, primarily because of low interest rates. And now you're seeing some stress in that segment because your interest rates have gone up. Then you have robo-advisors where there is some algorithmically savvy options that come to you, which seem like they're curated for your profile and for your needs. And then, of course, there's global equities because you're looking beyond just the country that you're staying in, whether it's other countries within Europe, whether it is emerging markets across the world, or if it's even an advanced economy like the US. And one of the most popular themes in Europe, or one of the most noticeable trends actually, is that a lot of investors are conscious about ESG scores and ESG related investments. So how have these actually fared out for investors? I think there is real trouble when it comes to real estate because, like I mentioned, your home loan rates are continuously rising. In terms, if you own a home in India, we are probably closer to the peak of the interest rate cycle, but system liquidity is getting tighter. If you have floating rate home loans, your rates are probably going to go up further. If you're in the Europe, we know that as of now, the trend that we have seen is that in general, Europe lags the US in terms of interest rate hikes by a period of 6 months. So clearly, your end of the rate hike cycle is not yet done. Your inflation also is turning out to be higher than before. You're well above your tolerance range. So there's a lot of work that needs to be done on the interest rate side, which means that real estate will go through more stress. The next issue that you have is that you need to focus on physical upkeep and maintenance of these properties, which essentially means that on something that you own, on an investment, you're spending more and more, right? Uh, and then, of course, there is this thing of finding and managing tenants. So if you have a house that you're using, that is one situation. It's not really an investment, it's more of an asset that you're putting to use. But if you're buying property with the intent of selling it at a later point, or with the intent of generating income by renting it out, I think there is a lot of work that is involved in finding and managing tenants because you do hear cases of um, houses which are locked up for months on end because they haven't found a suitable tenant, or you hear of cases where tenants don't use the property properly, and there are associated costs with that in terms of repair and maintenance. And of course, with any financial decision, whether it's real estate or not, you do need to consider what your income tax implications are going to be with such investments. And when it comes to real estate as an investment, you are looking at an entry as well as an exit, right? What we've noticed with the exit is that it takes a long time, and you can't do it at the last minute because it takes years to get out of a property, or if you do it in a rush, what tends to happen is you compromise on your exit price. So being aware of the cycle, knowing what the advantages are, knowing when you're going to enter, when you're going to exit, um, aligning this investment with some goal of yours. All of these are things that need to be planned out really well. And in many cases, there are a lot of moving parts, so it becomes a little bit more unpredictable to create wealth out of this asset class. Then we'll move on to your banking products, which are essentially your uh, fixed deposits in terms of NREFTs as well as the FCNR deposits and your insurance products. So I think when it comes to the deposits, although you do get a tax break in a certain sense, there is a restriction because the bank decides how long you should be investing, right? The bank FD, the NREFT is for a fixed number of years. And it's always per the bank's requirements. It's not according to what your goals are. So if you have something in say 3.5 years, unless there is a product on offering, you cannot actually put your money in there. Uh, Similarly, when it comes to endowment policies and ULIPs, the recent budget has reversed some of those tax benefits, and you need to be careful about where you're investing and whether it makes sense for you to continue these kind of products. The next thing is your endowment policies actually don't give you much back. On an inflation adjusted basis, your returns are close to zero. On the ULIPs, essentially what is happening is you're combining insurance and mutual funds and at a much higher cost to the investor. So it's easier for you to separate the components of a ULIP and do it on your own to create more wealth for yourself. And lastly, and this is probably the most important point, when you stick to only banking related products, you will end up with asset allocation imbalances, primarily because most of these products allocate heavily towards fixed income and don't give you enough equity exposure. And as an NRI, it's crucial for you to have some emerging market exposure. And India, as Harshil will take you through at a later point in this presentation, there's no better place for you to invest. So what about investing in advanced economies? I think here we need to look at where we are today in the market, right? Your economic outlook for the West is actually weak. You're seeing a lot of news on the banking crisis. So you had incidents with Credit Suisse. You're having in the US, three banks have closed in March. And of course, there's been this massive quantitative easing that has happened over nearly a decade, which needs to be reversed, right? And that reversal is going to be painful. So that's a key risk to keep in mind. You also have inflation at unprecedented high levels, which means that your profitability because of rising input costs is going to be declining. If you're in Europe, then you need to consider the layered currency risks, right? So if you're looking at a South American fund as your emerging market exposure, and you do it through something in the US, you have three layers of currency risk because you have your first currency, which is your euro, then you have your dollar, and then you have whatever the final currency is going to be. So being aware of this layers, knowing that each layer is kind of unpredictable. So your ultimate return, what comes in hand might be very different from what the fund actually performs. So that's something we need to be more cognizant of. Um, Also, your mutual fund space in Europe has very high expense on the active funds, given the kind of performance that you can expect. A 1% expense is quite high. Uh, and the market is such that today there's too much volatility for you to just stick to passive investments, because unless you are going to actively manage those positions, it's not going to work really well for you. So you need to have a balance of both time in the market and timing the market. And not many people honestly have the time or the energy to dedicate so much um, to their investments. So when it comes to ESG investing, I think it's important to be clear about what your objective is, right? There are three pillars with ESG investing. So you have the ethical pillar, you have the social pillar, and you have the governance pillar. Now, if you're looking at, so if you're very climate conscious and you want to choose an investment that works with that, you may not score equally high on the other parameters, right? So be clear about what your primary objective is, or bucket your portfolio into different categories where you're catering to each objective separately, because it's difficult to bring all of them into the same sort of framework. The next thing you need to be aware of is that labels can be quite misleading. So, for instance, recently we looked at a fund for a client who was interested in uh, like water conservation. So she found something in that theme and she sent across the portfolio to us, and we studied the fund and we realized that what was in line with her goal was a very small fraction of the portfolio. And you need to actually dig deeper than the label, because you can't just look at the label and assume that everything in the portfolio fits your framework. And of course, you need to be a little bit conscious about greenwashing, because that is something that happens in the industry. So these are, I think, three key points to keep in mind. And now we'll move on to what robo advisors can and cannot do. So there are advantages to having a robo advisor. I think it's very cost efficient and it's easy to access. Your involvement is also fairly low, but that results in fairly impersonal solutions. So what comes is you'll have a standardized risk profile, or you'll have certain standardized objectives, and then it works based on that. You also have low cost index solutions which are part of your portfolio, but we talked about how this is going to be a very volatile year, and probably just having a passive strategy is not going to work out well for you. So it kind of lacks nuance as well as customization, because for each investor that needs to go into a certain level. And then you have rule-based investing, which is a great way of being disciplined as an investor, but you also need something that's behaviorally adapted, right? We are not prepared for the kind of year that 2023 is going to be. So there are going to be bumps on this road, and you need to know how to respond to those kind of ups and downs that will come your way. So I think this is basically the question on everybody's mind, which is what about tax? I think depending on where you are in the European Union, you need to check whether there is a double tax avoidance agreement between India and your country of residence. So this is a very key step. So what a double tax avoidance agreement does is that it ensures that residents pay only one tax rate, right? Either the local tax rate or the Indian tax rate on their Indian investments. So, and how this works is there are two mechanisms. So you might either get a tax credit or a tax exemption. So a tax credit means you will pay tax in India, but when you file your income tax returns, you can claim that on your local tax returns wherever you're living. If it's a tax exemption, then you don't pay tax here and you only pay tax there at wherever you're living right now. So ultimately, like the best practice is that whether or not you have any income or investments in India, just file your taxes in India every year. Check your DTAA, see what it says, and that should give you a clear understanding of what works or what doesn't work. And now coming to managing currency risk. So we talked about how there could be multiple layers in your investment plan. So let's say you're doing mutual fund investments in India and you like the NASDAQ, right? So if you're going to do one investment from euros and then convert it to rupees and then do something in another market, then I think you have multiple layers. So you need to make those investments at the right time when it's really attractive and where those layered currency risks are not going to affect you. Uh, on the other hand, when it comes to currency, I think you need to also think about what are the macro level risks that are there, right? Is this economy stable? Is inflation under control? Because that's the need of the hour. Um, is this particular sector going to do well? So there's a lot of higher level data that you need to be looking at and that you need to be aware of when you're making these kind of decisions. And finally, you want to have some level of currency goal alignment so that you can manage that currency risk really effectively. So for example, um, let's say you want to send your children abroad to study in the US, then having some exposure to US markets makes sense. Or let's say you're fairly clear that you want to come back and retire in India, then it makes sense to have an India allocation. So working through these concepts, I think you can minimize currency risk. But honestly, this is one of the hardest things to understand and to predict. And like it's not something that you can do away with completely, but it is something that you can try to mitigate. And now I'll hand over to Harshil, who will be walking us through the second half of the presentation.
Thanks, Sam. So I think we spoke a lot about how we're looking at Europe, we're looking at advanced economies also. So I thought let's actually have some fun with data. Take a look at this chart. Assuming, if you just have to put, let's say, 100 euros or 100 rupees or anything into the market, 5 years back, what would that actually be today? Now, if you see, so I took the Europe index, which is basically the largest companies in Europe that you can invest in. So that index, you haven't made any money on it for the last 5 years. And if you compare it to the world, I think the world index has done much better. But if you compare it to India, and India has done far more better than the rest of the world, at the same time, it has done much more better, than Europe. So India, probably you will be able to earn around 11.5% sort of return in Indian terms. That is the last 5 years return. And if you look at the world index, I mean, it's good, but it's sort of lackluster when you compare it to the last 5 years. It has probably been about 4.5%. So there's a wide, outperformance. And usually this sort of outperformance, when you see over a long term, it has to do something with the fundamentals of that one particular country. Now, why has India sort of outperformed the world? Right, Sam, we can move on to the next slide. So this was very interesting. So a couple of weeks back, it was public information, right? There was a good interview and a good amount of data that came out on India. It highlighted a lot of stuff. So I'll just take you through, some of them. So India is actually going through the most unprecedented transformation of human history in the free world today, right? This was a very big statement that was being made there. Now, since India's independence, right, all our three pillars, that is social, economical, and political, they all sort of coming together now, and they are all sort of powering through. Now, if you look at India's GDP, just in terms of growth, so India's GDP right now is about 3.5 trillion rupees, right? So the first trillion took 67 years, the second one took about 8, and the third one is just took us 5 years. So from 2015 up until now, right, India has moved ahead of Russia, they moved ahead of Brazil and France, and right now we are number five. I think with the scenario that's happening in Europe, with Germany, and the other powerhouse that's there, we might actually see India going up the ladder to number four also. Right? And this is the story that has just begun because we are the fastest growing large economy on the planet, and two-thirds of this entire GDP is just driven by demand. Right? So this is where India's growth story is actually coming in, right? Where our demand is much, much more than supply. And for 8 consecutive years, we've seen inflows coming into India, and this is not through FPIs, right? This is through FDI route, right? Which means it's more stickier for us. Even during COVID, right, we received about 83 billion in just FDI money when everything was shut, and this was the largest we've received in any year. But the interesting point is it's not just in one particular state or three particular states, not just the largest metro cities, right? It's across India. It's going even to the villages that are there, right? So the amount of money that is being flown into India actually shows the level of trust that foreign investors have into the country, right? Where the new engine of India is going to be more bottom up. It's going to be more inclusive. India actually became the largest human resource on the planet. We have about close to 1.4 billion people in the workforce. And the most interesting part about this is everybody, I mean, the average age is somewhere around 35. Right, so we are going to be the youngest all the way up until 2070. We are the youngest human resource in the world. Right? And also there was a BCG study that actually happened where they said, okay, somebody born in the 2000 era, right? Assuming they would spend about, usually, right, based on those studies, they actually spend about 240,000 US dollars, right? And if you multiply that to the working population that's there, that is what actually India will be in next at least 10-15 years, right? Up until 2040, that is the number that they were looking at. That is actually the scope of growth that India has to offer to the entire world. And don't forget that the 11% of the world's population lives in our villages. So India's growth is actually going to be very aspirational. There are a lot of people who are wanting to be part of this growth, and they're not only going to be from the metro cities. Okay. So in the next 10 years, right, India is going to be the next USA is what they're deeming to be, but we do believe the same thing because every minute 30 people are moving from a village to a city in India. Okay. Now, with our currency that is sort of stable, India does present itself as the best investment opportunity for investors who are looking to create wealth in a very sustainable manner, right? Because there's a lot of volatility in the market now. On a sustainable basis, India does look to be the greatest investment opportunity that's there for anybody who's looking to invest in a country. Now, is it really that easy, right, to create this sort of wealth in India? Sam, you can move on to the next slide. This is my favorite data. No, every cycle is different. Every cycle celebrates a new winner and a new loser. Just have a look at this data. Nice color scheme. We found this data. We've actually collected the data also from various sources. But if you look at the winners of the past cycle, they have not necessarily been the winners of the future. Now, in 2017, if you see, small caps were celebrated in India. Everybody wanted to invest in the small cap space. And then 2 years later, if you see, they had to go through a wave of correction because valuations were extreme at that point in time, and people were willing to play any sort of business for a smaller player than a larger player. Also, if you look at gold, if you see 2013 to 15, it had the worst asset class run in its history. And if you see just from there, it has just powered through and just ran up to become the number one asset performing for the last 3-4 years. They've always come on the top two, top three sort of number. Now, to create wealth anywhere in the world, right, you need to own the right asset class at the right time so that you can be ahead of the curve. Now, what do NRIs actually want? Right, that's easy. I think what NRIs usually want is to save money in products, right, that can grow your wealth, can protect your wealth, and also help you retire. I mean, if you want to do plan to come into India, you want to live a stress-free life, and of course, you want to do all of that by minimizing the currency risk of a particular country, no matter where you want to retire, right? So this is where Sphere Neo comes in. There are a lot of products that NRIs get to invest in India, but there's nothing that takes into consideration the needs of a non-resident Indian. Now, we've curated this exclusively for NRIs because we want to take care of buying the right asset class at the right time. We've done this in the past, and I have taken one example going forward also, where we have shown that we want to take care of those being at the right place at the right time for you so that you actually can lead a very stress-free life. You can just contribute to a particular product, and then at the same time you can sort of relax, right? Now, we wanted to do this in such a way where anytime there's a need, we actually keep the product very liquid so that you don't have any problem in terms of funding whatever goals that come up, anything that can come up, right? It's unlike ULIPs or a bank FD, where you are stuck in terms of liquidity. It comes to you, only when it matures, and you also need a product that offers you that sort of growth level where you can consistently contribute to growing assets, to growing sectors, to growing themes of one particular country. So this is where Sphere Neo actually comes in, and I'll take you through one example of being at the right place at the right time and how we actually went through that particular process. So Sphere was not born in a day. It actually took us 12 years to develop a product that is consistently capable of taking advantage of market cycles in various asset classes in equity, debt, and gold. Now, we've taken this from our advisory service where we did do this for 12 years consistently since our inception, where we were able to take advantage of particular market cycles. Right. Now, I'll give you an example of this. So the pharma sector, right, was the most loved sector in 2020 because of one single reason. COVID happened. People thought the big largest pharma companies are going to save us. Vaccine will come out. Everybody is going to be safe. Wear your mask. It'll all be fine. But the actual story started way back in 2017 only, right, where pharma was becoming very, very interesting just in terms of values, pure valuations. Now, so from 2015 up until 2017, what happened was pharma had corrected nearly 40% from its peak. This was the last boom in pharma, where people were willing to pay any amount for same. People were willing to pay any amount for any amount of any business that was just had the word pharma. So 45% was the correction from there. So we started thinking that because small and mid caps are uh, uh, going up and people are willing to pay any amount, and the risk appetite in the entire industry was actually going up, right? We thought that it is better to take a more defensive stance. So when you look at defenses that are there are IT, there is pharma, and then there is FMCG. So we thought that, okay, the most interesting happens to be pharma, because now the focus of all these companies have changed more from an export oriented to more domestic demand driven scenario. Right. So we realized that yes, this is a place where we can start investing, because the larger players, right, in India, if you look at China, China is the leader. I mean, is the global manufacturing hub for everything. But on one particular thing, they could not come out on top, and that is pharma. So our Indian pharma companies, the large Indian pharma companies, were actually able to fill that gap in the entire world, and became, after COVID, it became very evident where India became the pharmacy of the world. But at that point of time, also people were, I mean, Indian companies were had the manufacturing capability to produce high quality products that China could not. So with valuations extremely cheap, we thought that it is good for us to start investing. So what our style actually is that we start building positions very slowly, because anything can happen. Things are very volatile. So we started building on the pharma space very slowly. We took our time. And we started buying 5%, 10% of one particular product, let's say 100 rupees. So 10 rupees is probably there on that one particular space. And we did this via the mutual fund space, because we wanted to take a basket approach other than going to one particular stock. So we started buying via the mutual fund route very slowly. And usually, right, when you start investing, your position never gets over in a day. Nothing happens in a day. So it took us nearly 3 years, right, to just sort of buy. 2 years. So 17 we started, 18 we were buying, 19 we were buying, and 20 was the last. I think January 20 was the last investment that went on to pharma. Not because of COVID, but because still everything else was sort of doing well on the fundamental space for this particular sector, and valuations were moderately cheap. So that was the last time where we actually went and topped up our pharma, and that was about 20-25%, around 22 would be the average of one particular portfolio. Right. So what happened after that was phenomenal, right? COVID happened, and then our investment started to play out. The way the investment started to play out was a little scary, because it went up too fast. And usually when we stagger our investing into, we stagger our investing out also. So the entire process took us about 3.5, 4 years, where we were able to buy slowly and also exit very slowly. Right. So the end result was that for that entire time frame, you were able to make more than index, at the same time make high double-digit returns. So what can Sphere actually do for you? Right. Versatility is the word that you should be focusing on. Sphere can help you create a versatile portfolio that can weather and protect you from tough market conditions to create wealth, right? That will in turn help you to fund your goals for the future. Now, with our robust process and product strategy, we can actually help you build a solid investment portfolio back here in India. And this is something that we believe every investor must do in order to win, right? You should align your portfolio to a particular goal. Now, you have to be patient with themes. Now, when it comes to investing with themes, like I said, uh, for one particular theme to play out, it takes 4 years. And this is something that we practice at Sphere Neo also, where we be very patient with themes. For a particular theme, it can take 3 years. For another theme, for another sector, or another idea, it can take 5 years. Right? So you have to be patient. And the only way where you can be patient and be mentally prepared is to engage with those opportunities where you can consistently contribute. Right? Just because something has gone down by 15% doesn't mean that it is a bad idea. You have to consistently contribute. Your research process needs to be extremely strong. Only then you will be able to engage with ideas. You cannot have a position that is just 5% of your portfolio. It's meaningless. I mean, it doesn't do anything when it actually performs very well. Right? So position sizing is very important, and patience is very, very important. At the end of the day, right, only when you're able to position yourselves well, you will be able to align your investing to a particular goal, and that can actually fund your goal. Now, in terms of how we've been able to perform, 2 years, I think 1 year, 1.5 years is a very small time frame. But I would say that since inception, we have done about 1.5%. This is last month's number. This month's number will come out in a day or two. But we have been able to outperform both the Nifty and our index because we run a multi-asset sort of a strategy where we don't have a cap on a particular asset class, right? So usually hybrid funds and balanced advantage funds, they have a cap, they have a mandate where they say, okay, if you're running an aggressive sort of strategy, then 60% needs to be on the equity space. If they're running a balance, then 40-50. If they're running a moderate, then it has to be 50. So we are running a flexi multi-asset sort of strategy where we don't have a cap on any asset class. We can go from 0 to 100 on equity. We can go to whether it is stock, whether it is mutual fund, whether it is ETF, wherever there's opportunities where we can build on a particular theme, where we can build on a particular idea, whether it is basket approach or individual, we can have a mix of everything, and we don't have a cap on any asset class. Right. So we also have exposure on the precious metal space. It's about 9% odd. Uh, at the same time, we do take options on our global side. So we do have an option to invest on the global side also. Right now, we are going very slow even on the global space. But on the equity space, for us, stocks and ETFs right now for Neo are the best option. So equity stocks happen to be 42% of the portfolio. ETFs happen to be about 8 odd percent. Debt ETF, because right now the opportunity for debt is opening up. So we are able to take that option on Neo as well, where we have about 20% odd in debt. So right now yields are going up, yields are firm at about 7.5. So it's a very good option for somebody who's looking to build on the debt side, and we are looking to build on the debt side. Right? The options are just opening up. So this is where our portfolio currently stands. We do have some cash also for options where we want to invest in right now. We have been able to deploy some money on this month. And that's about it on the performance side. Thanks. I'll open the floor for Q&A. You can type in your questions in the chat box and hoping for a good interaction.
Okay, so our fund management fee for the Sphere portfolio is flat at 1.5%, and it's across all the underlying components of the portfolio.
So there is a question, is Sphere and Sphere Neo different? Uh, the philosophy is the same. Neo is just an extension because we find that there are no products that are purely for non-resident Indians. Right? If you look at any other mutual fund or any other PMS that's there, I mean, you have to get the same sort of approach. They invest in the same things for you. So all our portfolios are curated differently. So when you invest with us, it depends on the opportunity that is there. So 6 months back, somebody who came on board would have a different portfolio than what you would have now. So every portfolio is created differently. Our investment process does allow it to do so because we have that capability. So every portfolio is different, but Sphere New is just an extension of Sphere where it is curated particularly for non-resident Indians, and the philosophy is the same.
So can an SWP be done in Sphere? Primarily no, because essentially this is a product that is oriented towards growth. So if you are looking at a multi-asset portfolio, we need a much longer timeline for it to run and perform for you, right? Meaning we would need 5 to 7 years. Doesn't make sense to have an SWP out of such a product, but that can be managed separately through mutual funds on which we can assist you.
What is the minimum investment to start with? So because it's a PMS and PMS does come under SEBI regulation, SEBI says the minimum investment for a PMS is 50 lakhs, 50 lakhs INR.
There is no lock-in period on this portfolio. We have a flat fund management fee of 1.5%. And if there are underlying products, like let's say you have an ETF in the portfolio that has an expense which is factored in, and additionally, if there are any transaction costs, those would be separate as well.
There is also no exit load, so we've kept it completely open-ended. The only thing that we are charging for is the management fees. So there is no exit load also. So the next question is, what will be the expected CAGR? Because we are running a sort of multi-asset strategy with no cap, you should expect in India 9 to 12% is a good expectation that you could keep. This is not a guarantee. There is no guarantee of returns for any of these products. But in India, 9 to 12% is a very good expectation. The next question is, what is your total AUM? So on as a house, we are at 1,000 crores. Sphere currently is around 230.
That's both Sphere and Sphere Neo
Yeah.
together. Okay. As an NRI, there is a double tax avoidance agreement between India and Germany. Is paying tax separately in India enough by by regularly keeping up with tax return filing? No, you would also have to comply with whatever your requirements are in Germany. So if you are expected to disclose your assets there, or if you're getting a tax credit, then you need to disclose all of those things. So you need to do both, actually. Okay, we can
So
go
there's a
back to
yeah.
the performance slide.
So there is a question on Neo is not very attractive. Am I missing something? So I would say that it's you're not missing anything. But we started only in October 22. I mean, Neo was only started in October 22. It's the same philosophy that we are running on Sphere also. But because it's a very short time frame for you to judge, I wouldn't say that it is not very attractive. We are still in the building stages of we are still building the portfolio very well. As you see, we have a good amount in cash where we are able to deploy now in volatile markets in India. Markets are correcting, barring the last 2 days, but we have been able to take advantage of this market correction, and we are building our positions now very slowly. As you see, we do our investing in a very staggered manner, where we want to build high conviction positions that are there. But since October, I mean, for 3 4 months is a very short time for you to judge our performance. Over the long term, this sort of strategy has been able to deliver north of 14% return. That is over 5 years plus. But our expectation that we are setting is around 9 to 12.
Also, we need to come back to the one of the things that we were saying at the beginning of the presentation, right? We feel very strongly that 2023 is not going to be a performance year. It is more of a participation year. So even if you do look at investing in this product this year, you're not going to see great returns. But at the same time, it's structured in such a way that you are protected from the difficult situation in the market, right? So even if we look at our 3 month performance, or what we've or like since inception, we've kind of fared better than the index also in these cases. And of course, our March numbers will be available in a couple of days, so we can show you those data points. And if you feel not very comfortable with the performance today, then you can keep an eye on our product. You can see what we're doing month on month, and then take a call as to whether this works for you or not. How frequently would I be updated on the asset allocation? So on a monthly basis, you will get your portfolio statement, and from there you can track the asset allocation. Uh, that's uh, like we're fairly transparent in that manner, and also publicly we do publish this information every month as well. This is more on the aggregate level, but you will get your own individual account statement on a monthly basis. With respect to Mr. Ankur's question on having beaten the index for more than a period of 5 years, so from our company history perspective, we used to have an RIA practice, where we were advising primarily on mutual funds. In that scenario, we were able to beat uh, I mean, we were able to beat the index. And over a period of time, we've evolved this product into something that's more cost efficient for the investor, because we're looking at direct stocks as well as ETFs, which have a lower underlying cost. And the core philosophy is the same, right? So, taking all of that into account, yes, we have been able to beat the index consistently um, in the RIA platform, and we are fairly confident that we can continue that kind of performance here as well. In fact, it's a lot more likely to happen in this case.
So just to put some numbers also, the last 5 years Nifty return has been about 9.5%. So even during 2018, right, you saw that from the chart that I had shown, that Nifty has done about 9 to 12, and from our RA practice that we've been following with the same philosophy, it has been north of 14. So yes, we have been able to beat the index over the long term, but for us, our benchmark is not the index. We, of course, we have to put the index because of regulation, but for us, it is very important to beat the alternative that is there, that is Nifty, at the same time grow more than the country, more than GDP growth. Doing that, beat inflation also. So that is our long-term goal. If you say 10, 15-year plus sort of growth number, that is what we have in mind. 1 year, 2 years is not a good time frame for us to even look at.
Uh, yes, probably after the call, we can send you the performance data for Sphere. I think Sphere started in December 2021, so we have 1+ year data for that. We do not have 2 year data on Sphere. I am an M2W client with ithought now. We want to build a larger position and then move to PMS later. How will it work? Yeah, so I think that's the whole aim of the Milestones to Wealth program, right? Meaning you want to go from where you are to one milestone of 50 lakhs. So we will work with you consistently on that journey. And then at that point, when you hit that milestone, you can decide whether you would like to continue with mutual funds or if you would like to move towards a portfolio management service. And that transition will also happen based on how the market cycle is and what would be the best way for your wealth creation journey. We can take a call at that point.
So there's a question of how does the investment work? Can I use my existing broker or demat account? No, we will have to open a separate account and a demat account for you, depending on who you currently have as a broker. That we can take it up offline, depending on what your scenario is. But in a nutshell, you will have to create a new demat account with us. So we have partnered with HDFC. So we can take it offline, but in a nutshell, yes, you have to create a new demat account with ithought.
What is the action required for an investor after the investment is started in the PMS? Are any additional investments expected? Yes. So the product is actually built for scale, which essentially means that after you make your first investment, you can continue to contribute consistently to the portfolio. We have a very long investment horizon, so we prepare clients to stay in for at least one market cycle, which would go from 5 to 7 years. So the best result for the investor comes when they participate more and continuously through that cycle. So even if we go back to the example of how we did pharma, right? There were a lot of incremental investments that had come in over those years, and that contributed to better performance. All right, thank you, everyone. Happy to connect outside of this. See you soon.